by 0.5%. We are back with Jay Brown, Chief Executive of MBIA, and we're also joined by Bloomberg's Margaret Popper. Margaret.
Thanks, Rhonda. Jay, wanted to ask you about the future of the structured product market. Obviously, this was a huge market in terms of buoying mortgages, buoying the growth of people owning homes in the U.S. Now it looks as if it's virtually dried up because of the mortgage side of this. What is this market going to look like?
That is a good question. I think over the next 2 or 3 months, it's going to be pretty moribund. I don't think there's going to be much structured products issued. I do think that the benefits of securitization and the mortgage market will return. It will spread back, and we will be back in business, certainly at MBI, in 6 months, participating in that market. But the exact structure of that market, the products that are offered, how they're rated by the rating agencies, all of those still remain uncertainties for new business.
Well, so Jay, in terms of your business model, how do you plan for this? You've got a market that you have no idea what it's going to look like. Obviously, if you look at your stock price, there's some serious questions as to whether you have a business model going forward.
Well, when we look at our business, one of the things to understand about our business model is even if we do no business this year, our revenues are essentially going to be 92% of what they were last year. If we do no business the year after, it's still going to be roughly the same revenue base. That gives us the luxury of redesigning ourselves to take advantage of those structured markets as they reform in the second half of this year and into 2009.
Do you expect to get more clarification when we hear from the New York State insurance superintendent on new regulations? Is that what you're waiting for, essentially?
No. We are not waiting for New York to come out with new regulations. We have decided as an insurance company we are not going to participate in the derivative market. And over the long term, we're going to separate our public finance operations from our structured finance operations in terms of two legal entities in the state of New York and in other states. I don't know yet what Mr. Dinalo and his associates are going to come up with for regulations, but I have a pretty good feel based on what I've seen in the market, particularly in the last 6 months, some of the elements that are going to be there, and I think we're going to be well positioned to take advantage of that.
Well, on the municipal side of this, you bring up an interesting point here. Obviously, you've got two businesses, and the municipal side is a big one. One of the issues, though, is that as the bond insurers' ratings came under fire, the market kind of found out it could do very well on its own, thank you very much. You've seen states like New York and California coming out and issuing without insurance. Are you concerned that even that side of the business, because of the rotational you've taken, that dries up?
Not over the long term. Last year, the year before that, over half the bonds that were issued in the municipal market went uninsured. That percentage that we insure or don't insure goes up and down as a market and as MBIA. It's not at all surprising to me right now with all the turmoil that there's a greater percentage of bonds issued without insurance because it's hard for issuers to quantify the value when they issue those bonds of insurance over the past 2 or 3 months. We've been through these kind of crises before. I think the bond market will return to some form of stability relatively quickly. At that point, we will stand ready to assist issuers to access the bond market as cheaply and as efficiently as possible.
California seems to be very vocal, though, in what's been going on. There was a quote in the Wall Street Journal over the weekend, a spokesman for the state treasurer saying insurance has no value. It would be a waste of taxpayer money. Now, do you see that as a comment that is just temporary in place now and that things will be back to the way they were before? It just doesn't seem that that could be possible based on all that's happened.
The world never goes back to exactly the way it was before. The value of our product, it always has to be in the mind of our issuers. The state of California is the 4th, 5th, 6th largest economy in the world. It might feel it can access the global capital markets with its bonds without using insurance. If we can offer insurance and it offers value to them, then they will choose to use insurance. That depends a lot on their fiscal condition at a particular point in time. At this particular moment, they've made a choice. They don't need insurance. I'm pretty certain that will not be the case for the long term.
Jay, in hindsight, was it a mistake for MBIA to be insuring auction rate notes? And is that that you're going to be insuring in the future?
We will be in the auction rate market in the future. I think like all variable rate markets, particularly short-term, weekly type markets, there's credit turmoil across both the public finance and the taxable market. The people who buy these notes have a lot of opportunity to buy virtually anything. In fact, if you have cash right now, this is a buying opportunity for all sorts of fixed income instruments. It isn't surprising to me that some people are pulling out some money of the variable note market and putting it to work in some other markets that they see higher returns.
Let me ask you about your asset management business, as far as where you see that fitting in.
Our asset management business is a business that's about 10 years old. We started at our own company. We started by managing our own funds. We've grown it over that time period from roughly probably $6 billion to just above $60 billion. The skills in that business match very well with what we do in the insurance business, which is rigorous credit analysis and manage your liquidity. And that's what they do for both all sorts of different third-party clients, including many, many municipalities, from their money funds to their pension funds to long-term construction funds. And then we also do a wider variety of offerings for other third-party investors.
So you're going to keep it?
Absolutely.
Have you seen any investors want to withdraw money?
No, we actually got $250 million in brand new money from a big investor just last week.
Okay, we've got a lot more to talk about here in the remaining hour. We're going to actually expand our discussion a bit into the municipal bond market. Paul Brennan, portfolio manager with Nuveen